given the sell-off we're seeing in big cap tech names right now, and given the fact that they were the leaders in stock gains over the last couple of years, can this market rebound without them?
No. Market cannot rebound without them, but they're tremendously on sale. We've seen that in the last couple of weeks. So if you loved all these names, which I've loved Square, I've been long Square since a $12 handle on it, traded as high as $100, but I feel like I'm broke now. Now it's $63. So it was a paper loss. I haven't taken it yet, but it's still sort of dark and gloomy for tech. You need to see the rest of the market catch up. But look at housing today. You want to talk about quote unquote value? It's been decimated. It's been sold off. Bad news today, and the whole complex is green. So maybe in certain areas, we're putting in a bottom.
Dan, where do you stand? Do you agree with Jim that you've got to be defensive, or with Steve that some of these stocks have sold off too much?
Yeah, I think it's a little bit early to get defensive. I mean, it feels uncomfortable right now, but that's how it should feel. I think that the key concerns of the market today are that growth is going to go away or that liquidity is being pulled out too quickly. I think both those concerns are premature. If you just look at third quarter earnings season, it's knocked the cover off the ball. People have been saying all year long this is as good as it gets and continues to do better than expected. And if you look at the history, there's a lot of people talking about peak earnings, but we're not really at peak earnings. What we're really talking about is peak earnings growth. And if you look back at the history, peak earnings growth is not a bear market signal. It's actually more of a bullish signal than anything. And the thing with liquidity is you'll know when the Fed has tightened too much because the yield curve will invert. And we're not there yet. And to say that we're close, so you should be bearish, is again not looking at the historical data.
The Fed I'm sorry to interrupt you, but the Fed should be focused on where we've seen growth going, where the puck is going to be, not where it was. And usually the Fed is always looking rear window.
Right, they're always a lagging indicator.
So that's the problem,
absolutely.
is that they always wind up pushing and causing every recession that we've had, and Correct. It looks quicker and quicker that we're approaching that recession.
But the way you know, it's not a dimmer switch, it's an on-off switch. So if you look historically, some of the most bullish times to be invested in the stock market are when it's incredibly flat and flattening, but not yet inverted, and that's kind of where we are today.
Rick, what say you on this discussion, especially when you look at a 1-month chart of the 10-year Treasury yield? I mean, my goodness, it's been very significant in terms of the move up and then the move back down.
Yeah, I don't know. If somebody really pressed me, I would say rates have had their highest closing levels for the year. I think that's pretty hard to argue with, actually. The double top in 10-year note yields right around 323. I mean, consider this. We have a double bottom, a giant double bottom in 10-year note yields from July of 2012 and July of 2016 at 135, which means in basically 2 years, 10-year note yields have more than doubled. And, you know, the old mantra was, oh, interest rates are so historically low that these little moves won't really make a difference, but they do. We had Peter Bookfer on. It's like a log jam of credit as it continues to flow from investment grade to less investment grade into high yield, and then the ETFs, which really never existed the way they do now, are much faster in an adjustment, but the securities in the garage of these ETFs take a long time to process, and the whole thing ends up getting bogged down a bit. Now, I'm not saying that stocks can't go up again or that this is the big one, but I do think that interest rates most likely have peaked, and it's going to be very fascinating to see two things. To see the comments, should the Fed tighten in December, and I think they will, regarding how we've moved down a bit in rates and how the volatility in equities may affect them. And obviously the China story is a biggie, and I think that played with some of the volatility today. The dollar index, everybody's looked at it and kind of painted it with the same brush as treasuries. It's given up a lot of ground with respect to yields falling, but it's still holding a 96 handle. I still say the dollar index is a bit of a bright spot, and it's holding quite well, a bit between what, about 4.5% up on the year, but almost 10% from its lows in February. And the problem with the dollar for businesses isn't its level, it's its movement, it's its volatility. Even at lofty levels, if the dollar index starts to go sideways a bit, it eases the pressure on many of the multinationals.
Steve, just quick final thought. The APEC meeting over the weekend, what did you make of the tone there? Does it now put aside any hopes for progress in G20?
No, I think if anything, it should give us more hope. We have more leverage over China.
The tone from the Vice President gives you more hope?
Well, the tone, not only the tone, but just look at that tone hasn't changed. That's been the same. But what has changed is it was seen as USA versus China. Now it looks like there's more people, or at least splitting some differences where it's a lot more behind the USA. It's not just USA going it alone. A lot more agreement. That gives China less leverage at G20.